Right. Happy Saturday. Welcome to our live rental income properties 101, buying your first investment property. My name is Vinnie.
I'm David Wright. Welcome.
And let's just jump into this.
Well, so you already own your home. You knew what it took to buy your home. You remember the process. You remember the procedures. For those of you who haven't seen our first-time buyer seminar, it actually will walk you through the whole buying process. If you're curious about that, I know a lot of you are more into investments on this seminar, but there is a first-time home buyer course we do as well. So back to the game. So you already own your home. Your income is steady. Your job. You have a retirement plan. You have savings. Your house is appreciating in value. But this alone is not going to create lasting wealth for you. You need to have diversified investments, and you need to have investments that are working while you're sleeping. Even though your 401k and your stocks do that, your house does that as well. And if you are listening to our market updates on Monday, it was once again predicted 3 to 5% appreciation again going into 2021. And appreciation yearly is not always what, Vinny? Appreciation again going into 2021. And appreciation yearly is...
Yeah. It's
not always guaranteed. Vinny was going to say we're going to have to talk to our producer over there. I know they're busy today. We have a large staff that helps with the production of the show.
See, we do this thing, twice, and sometimes David is not aware of it. We're usually on the same page, but sometimes it goes right over David's head. But anyways, yes. All right. How does investment properties build wealth? Monthly cash flow. Rental properties create cash flow. Rental properties have the ability to increase cash flow by rent increases. Average San Diego rent is $1,800 to $2,750, and it's definitely going to go up over time, and in bad times, 2.7. Future appreciation. San Diego average appreciation is around 5% yearly. In bad times, 8% loss. Now, things to think about, like David was kind of saying, well, I was taking care of something else, but again, over David's head. You can't focus on future appreciation. Focus on the now. Focus on the monthly payment. That's going to be your biggest takeaway. We do have a shortage of inventory, as David talked about on our market update. We talked about that greatly. We're going to need probably a lot of properties to really hit the market to see a change in the market. But yeah, focus on the now, because that's what we know. Rent appraisal, mortgage appreciation also always goes up.
Tax write-offs. So me and Vinny like to talk about this because, first of all, we are not CPAs. Let's be clear. But rental properties, one of the great things about them is tax write-offs. So when you own your own primary residence and you repair the bathroom or upgrade the kitchen or you add a retaining wall, that's not tax deductible. When you're working on your investment property, all your improvements are tax deductible, which is huge. You can also depreciate the rental property, which on your taxes will reduce your taxable income, which means you get to keep more money. So the final thing is you're also writing off property taxes, insurance, mortgage insurance, maintenance, all of that stuff is all getting written off. Those are things that you don't write off on your primary residence. So if you like paying a lot of money in taxes, well, that's, your prerogative. But the rental properties reduce your taxable income because of tax write-offs.
All right, how do you get started? You need money. You can pull out money of your current home, like cash out, refinance. Things to really think about, and we've talked about this greatly. Rates are historic lows right now. If you bought your property maybe a year and a half ago, somewhere around there, you probably have the ability to refinance, even take money out of your property and possibly not have a drastic uptick in your monthly payment. So look at look at what you have currently. You might be able to either take money out to buy another property or an ADU, like a quote unquote granny flat. But talk to a lender, talk to a realtor like myself, and we'd love to kind of walk you through that. You can pull from an investment account or bank savings, IRA, real estate investment accounts. Pull money with other investors to leverage. Be aware when money's involved, things get crazy. So make sure you have everything in writing. HELOC on your current home if you have an amazing loan already. Cash is king, but cash flow is magic.
It's magic. So for those of you out there, our market updates are going over interest rates historically all-time lows. Your jumbo mortgage, which by the way, Vinny, I forgot to mention on Friday because I know we had some technical difficulties, but there is now jumbo loans available with just 10% down. They're back.
Oh, wow.
Up to 1.5 million.
This week?
That happened this week.
Wow.
Yeah, that's pretty crazy because if you remember back a couple months ago when the pandemic hit, all of the jumbo products went away except for 20% down. They're now back with 10%. So maybe that's a sign things are getting better, or maybe that's also a sign that home prices are getting so much higher that the demand out there is needed for 10% down, because a lot of homes now, shoot, they're $850, $900, $1 million.
Yeah, I mean, it's been a definitely interesting market. All right, so if it's monthly cash flow that you're looking for, do you want the highest monthly cash flow? Do you want the ability to be able to increase your rent yearly, or are you just getting the first property and then later planning on cash flowing because of rent increases? I mean, diving deeper into what you're looking to accomplish with this purchase is going to be a really a big takeaway. If it's yearly appreciation and you want to buy in an area that has the greatest yearly appreciation, or buy in areas lower appreciation because of price, or buy because of appreciation down the road for financing improvements. Now, when you're dealing with a single family home, appreciation can happen maybe with upgrades you do to the exterior of the property, add-ons and things like that, or beautify the house around you. In a condo or other properties, you're more focusing on the inside of the property and upgrades you do there. Or you can deal with appreciation in the community where you have quote unquote gentrification, where the community starts getting a little cleaner, a little better, a little more.
I knew that was coming.
Yeah. So appreciation, or it could be solely reliant on the market, and that's always a tough thing to gauge. I mean, most of the time, people will tell you the market's going to go up in a year from now, right? And the other half is telling you the market's going to go down from a year from now. I mean, there's barometers that you can play out, but some of those barometers don't really give the full picture. So,
safety of investment. Can I jump in on this one?
Please.
This is one of my favorites right here. So you're investing your money. You worked hard for your money. You saved. Maybe you cut out all your Starbucks. You cut cable. You got a Fire Stick. You've done a lot to save this money. So you want it to be safe. So is one of the most important things about it, is it the location of the property? Think about it. Would you want to live in that property? Do you like the neighborhood? Is it safe at nighttime? The stability of the monthly rents coming in. This will go into who you rent to, which we know is always different, because you could rent to a family, you could rent to college kids or young adults, you could rent to an executive, you could rent to someone military. Everyone is going to be different as far as how stable they are with your rental property. If you remember back when you were a renter, did you take perfect care of the property? Did you respect the property? Did you care about it? Did you do improvements? All these things become important when you're putting your own money into the house, and you really want to start thinking about, who do you want to be your renter? The other thing is, how much of maintenance is needed on the property? If you're, buying in, let's go North Park and the house is 1939, how much maintenance are you going to have to do? You really have to think about all these things ahead of time, because once you buy the property and the deal is closed, if you didn't think about your tenants, the maintenance, the rental, all this stuff, it's going to be a problem for you. Well, now that you got those things in mind, you look at it, you go, well, what property would you want to buy? You have single family residences, you have duplexes, which is one in the middle, and then you have 3 to 4 units, one in the corner. Each one has a different barrier to entry, which a lot of it is price, and each one has its own level of difficulties. As if it's your first rental property, if you have one tenant, that's one stream of income, and that's one potential issue you deal with. As you know, when you add people into the equation, the more people you have, the more problems can arise. So if you go to 2 to 3 to 4 units, let's take 4 units as an example. So you have 4 rentals. You're dealing with 4 different people, 4 different levels of maintenance, but that's 4 different levels of cash flow. So the name of the game here, what we're trying to do is create cash flow for you, which creates passive income, which creates more wealth. So if it's your first one and you want to take it easy, go with single family. If you're a more gung-ho, Bravo type person, go with 3 to 4 units.
So, yeah, what David already kind of talked about, each one has their own positive, negatives. It's really focused on what you're looking to accomplish. Usually, the more people you have renting the property, the more money you're going to get out of it. Yet, if you don't get the right tenant, it can be more headache out of it. So it's kind of a give and take. Is there a wrong property to start with? Of course there is. Remember your goals here and your financial situation. Can you afford to lose a renter? Do you have the reserves for things to go wrong? Because they will. Can you bootstrap and do your work yourself on the property? David loves that word. Do you have the patience to work with people? Now, if you're getting a fourplex and you don't like working with people, it's going to probably be a little bit harder doing it. If you have a 1 unit, could be a little easier, especially if you get a good tenant in there, you might never hear from them. So really be aware of the situation. Maybe you need a property manager. You do take on a property manager, they're going to charge you. So things to think about.
What's the average property manager charge, Vinnie? Just so people kind of get a general idea.
I mean, it's probably gonna vary from a property management company to a property management company, but usually 6 to 8% of the rent.
So that's something to think about when you're looking at your cash flow. And when we go into our formulas later, if you're losing 6 to 8% to someone managing the property, or are you gaining time by delegating that to a property manager so you can do other tasks? Because time is money.
So let's take a look at some ways to prevent you from choosing the wrong property. Know your neighborhoods. Know the area that you're buying in. What is the average income? What is the average rent paid? What is the crime rate?
Ooh, that's so key.
What is the rate of appreciation? Now, crime rate, you can go on a platform called crimespotter.org.
Great website.
Rents paid, rentometer.com. What is the rate of appreciation? Average renter turnover in area. Know the property. What is the age of it? Deferred maintenance of the property. Piping, electrical, roofing. If it's an older property, it might have some corroded piping. So something to really look into. Permitted or not permitted work. I mean, there's a lot of communities that have areas that are not permitted. So you take kind of a risk on. Usually you're going to get a little better value in a property like that. Yet something to really think about. Are you okay with permitted or not permitted? Accessibility to parking in downtown. Something Davis talked about before. You have a property downtown or maybe in some areas of like North Park, Normal Heights, and those kind of communities, Mission Hills. You have 1 parking spot per maybe a 2-bedroom. It's going to be less appealing than a 2-bedroom with two-car garage, just because parking can be tough. So things to really look into when you own the property. And then zoning, legal, upside in the unit. Based off of the area you're in, know what's possible. Right now, the ability to add on quote-unquote ADUs, granny flats, has really been freed up a lot. So that could be something to really help in building out your investment portfolio.
And you know what, right there, what Vinnie mentioned, number 6, zoning. When you're working with an experienced agent and someone that knows the ins and outs, they may find you a house that was a single family residence, but it's zoned for 2 units. That is instant upside potential for you later on to add another unit and create value instantaneously. And then from a lender standpoint, number 4, permitted versus non-permitted work. Well, permitted is always worth more. But at the same time, as a lender, we look at everything. Was it done in a workmanlike fashion? Does it look like it was done by a professional who knew what they're doing, as opposed to somebody that connected wiring with tinfoil and then put it in the wall? That whole permitted versus non-permitted is huge. It's another value creation. By working with a smart agent, they can point out to you, reading the property, looking into it and going, hey, this is not permitted, or this is permitted, and that's why we're getting value here. So it really pays to work with someone experienced to make sure you get the right property on these things.
Yeah, I mean, there's always confusion of what kind of value with a permitted and unpermitted area. There, you get value, like David was saying, of unpermitted area. You don't get full value of it because there is value in that area, especially if it was built in a workmanlike condition. So things to think about when you're looking at properties. Why? Okay, because you don't want to lose money in your purchase.
And you got to look at this as a work-life balance. Me and Vinnie are all about that balance, health, money, everything. You have to have a balance. You don't want to buy a property where you're just constantly tipping the scales to dumping money in it, or you're constantly tipping the scales where you're constantly maintaining it with the people. You want to have a balanced approach because we're all about having a balanced life and having time for you to sleep, enjoy your family, and make money at the same time.
Yeah.
Learn about mortgages. So what do you need to learn about? Well, you really want to learn about mortgages. How can that really help you? Great CPA. Non-owner properties, duplexes have higher rates than single-family residences. When you buy as an investor, you usually need 25% down. 3 to 4 unit properties will have higher rates than 2 units. So it's something, if you're listening to our different updates and different seminars we do, the rates on a single-family residence are the lowest. Then it goes duplex. And then when you hit 3 to 4 units, they go higher. So you also have to keep that in mind when you're doing your formulas and your cash flow and what are you going to get is what sort of property you're going to buy. And then the final thing is the more equity you have in your property, the better interest rate you'll get. Me and Vinnie like to mention this because if you're working with someone like Vinnie and he finds a deal for you that's, you look at it and you buy it on market, but then later on when we evaluate it, we're like, wow, there was 10% equity already in here. We get to use that value to help you get a better loan. So just as, let's say an example, let's say you purchased a house at 600, but the appraisal was at 650. That's instant equity, which helps your interest rate. CPAs are worth their weight in gold. The cheapest is not the best. If you're going to go hire a cheap CPA, you will get what you pay for. Please remember that. It's just like going, hey, I hired the cheapest plumber I could get when my bathroom overflowed. But then a day later, it broke again. You get what you pay for. Don't go cheap. Save your money. Buy quality. CPAs can also help you when you're 1031 exchanging properties. They can help you gain back the depreciation that you're supposed to pay when you sell. A smart CPA will know the loopholes to get you that money back. Super key. I see that all the time. There's a CPA I work with that saves a lot of people money when they sell their properties so they don't pay back the depreciation they wrote off.
Yeah, I mean, and if you don't know what a CPA is basically an accountant. So, because I brought that up to someone the other day, and they're like, "Well, what's a CPA?" And I had to tell them. So, if you're not aware of that,
did you tell them LOL?
No,
because everything's 3 letters now: CPA, LOL, OMG. Wow.
But yeah, 1031 exchange. If you have an investment property right now and you're looking to make more money off your investment property, you can at least transfer over the capital gain from there to the next property, as long as it's cost more. Things to kind of think about, and right now, and usually when you go up in a higher price, you're going to have the ability to maybe jump from a single family to a multifamily property, and then your rent should go up. So things to kind of think about when you're talking to a CPA about the possibilities. And then make friends with an honest contractor. That can be so huge, especially if you're not willing or don't have the ability to bootstrap something and fix it yourself. Talk to an honest contractor, find an honest contractor, ask your friends, go on Yelp, all these different, ask your realtor, ask your lender, whoever it is, because if you can get someone that can help you out with small fixes, it'll make a world of difference.
So true. It's hard to find an honest contractor. It sounds easy, but it is very difficult. Oh, so this is one of my favorite areas, formulas that can help you. So you thought about your investment, you thought about doing this, and you go, how do I know if I'm making a good choice? These are 3 formulas me and Vinny like to share because they're easy and they're actually super helpful. So cash on cash returns. So, we're looking at the cash on cash returns. For example, if you bought a house at $700,000 and your down payment was $175K, and your annual cash flow from rents, you look at it, it's $3,500 a month times 12, that's $42,000. Here's how you find out what you're making. You take the $42,000 divided by the $175K that you put down, you're making 24% rate of return. Is that pretty good, Vinny? What do you think?
That's a really, really nice return.
That's an amazing rate of return right there. We like to use that one is, it's not as realistic, I hate to say. Vinny usually points us out. I'm just going to step in and kind of correct myself a little bit. Most of the time, you're not going to get a 24% rate of return on your cash. If you're getting 6 to 8%, that is amazing. But $3,500 a month for rent in San Diego is incredibly common.
Yeah.
That right there is incredibly common. Let's look at the next one, net operating income. So net operating income. So you look at this and you go, what's your annual income minus your annual expenses? This lets you know, can you afford the property if you lose a renter? So in our example, you're bringing in $42,000 a year in rents, $3,500 a month, but yet it costs you $12,000 a year in maintenance to keep this property going. So now you look at it like this, you take away $42,000 minus $12,000, $30,000, and then look at your mortgage payment and go, can I cover my mortgage payment based off of $30,000 in income per year? If you can, you've already accounted for your maintenance expenses and your debt service, which means this is a safe investment that you can sleep at night and look at better. And finally, payback period. So this one's crucial. So you worked all this time to save all your money, and you're like, well, if I drop $175K into a house that I saved for, when do I earn my money back? So using our example again, you put down $175,000, you make $42,000 a year in rent. That means you basically earn back all your money in 4.17 years. It's not bad. These are easy formulas. You can use them wherever you like. They let you know, is the investment, structurally sound from a basic standpoint. You do have to look at other things me and Vinny went over as far as location, parking, maintenance, renters. But these are great formulas that you can use just to get you started, to let you know, hey, this is a good investment. This does make sense.
Yeah, if you want these formulas, feel free to reach out. We can get this over to you. So what else do you do to protect yourself? Learn California renters laws. Only hire a qualified realtor to help you and a qualified lender. Okay, property managers, do you need one? Learn the cost. We talked about this already. Usually vary between 6 to 8%. Plan on things going wrong because they will go wrong. Great insurance companies better than a cheap insurance company, right? If you need a good insurance agent, I have someone I can connect you with. So feel free to reach out on that. Realize you're playing the long game to create wealth. Be prepared to take some risks that are calculated, though. Okay. Cash king and queen. You'll need to operate and ensure you can sleep at night. Buy rental units, live in one for a while, and you can fix it up. And this is great right there. I know a lot of VA buyers. They'll buy maybe a duplex, live in one of the units, rent the other unit out. Now they're getting someone to assist them with their monthly mortgage. So things to really think about if you have that ability. Always look for ways to increase value and always equally increase rents. So equally increase. Were you going to say something, David?
I was going to say, to mention what you said right there about the VA, as an example, I have a buyer that basically bought over in La Mesa with VA about 9 months ago, and he basically bought a house with 2 units, and it was a large house and a smaller house on the same property. He bought that with 0 money down, and then basically now he's fixing it up. He's going to move out and he just got a rental property with 2 units with 0 money down. That's going to cash flow positive $1,000 a month. So it's amazing what you can do with this, especially if you're going to get more savvy with FHA deals, buying, let's say, your first duplex with 3.5% down. Interesting way to do things, and your VA. There's a lot of more savvy things you can do with this. And you really want to talk to your agent and go, hey, these are my goals. What do you think we can do? Could I use VA or FHA to actually get 2 units or 3 units and have it make sense for us?
Now that you have the basis, go look at properties. What do? Hire a great agent and a great lender. Know the areas. Look for the rents. Use the formulas. Know your goals.
Boom.
Because cash is king and queen.
That's because we're super fair. That's just the way we roll, Vinny.
I mean, we try to keep this short and sweet, giving you kind of an idea of what's possible. There's so many things right now, especially. I mean, if you haven't bought before, I mean, it's a great time. I mean, but if you bought something even a couple of years ago, it could be a great time to refinance, take money out, and look at a second option. So if you have any questions, there's my information and David's information. We'd love to help you out with whatever we can.
Yeah, we did this. I mean, the goal is 30 minutes. I think this could be a PR right here. We may have to, send this to Rogue Fitness and tell them we got a personal record today with our buyer seminar.
Yeah. Well, follow us, subscribe, and join our market updates. We really go over in more detail about the current San Diego market, so you get a better reference point of what's going on in San Diego. And again, if you have any questions, reach out to myself or David. Even if you're looking to buy maybe in a year from now, 2 years from now, 3 years from now, or just in a couple weeks from now, whatever it might be, we're here to help, here to answer questions, and we want to be that trusted resource for you.
Yeah, thank you guys for your time. We appreciate it, and wish you a great Saturday.